Hello, I'm Hunsley of Livewire Markets and welcome to Views from the Top. Our guest today is David Cassidy, Head of Investment Strategy at Wilsons Advisory. David has been in the market since 1991 and has worked at places such as JP Morgan and UBS, where he also served as Chief Investment Strategist for Australia. David, it's great to see you. Thank you for joining us here at Livewire.
Pleasure to be here.
We're recording this interview in early December, so I thought we could start the scene given the time we're in. What has stood out to you as a professional investor from 2023, the year it's been?
Well, I think firstly, the resilience of the US economy. The much feared US recession hasn't happened, or at least not yet. And I think off the back of that, the strength of the US stock market's also been, I guess in hindsight, a surprise to most investors.
Well, we talk about the US recession being, delayed, but not happened yet. Are you in that camp as well, or do you think the US will achieve that soft landing?
We're in the soft landing camp. I actually think probably 24, there's more risk of recession than 23. We're in the soft landing camp for 23. We're still in that camp, but I think the risks are rising given that rates have been high for some time now. But base case is we can still have a soft landing in the US economy in 2024.
Okay, interesting. So when you joined Chris Conway for the Asset Allocator Roundtable last year, I know that you were underweight cash, relatively equal weight equities and bonds, and overweight alternatives. So I'm curious to hear, how has that allocation performed this year? And is there anything you wish you would have changed with the benefit of hindsight? I know that you were mentioning US equities just now.
Yeah, I think if you look at that, let's call it a balanced growth fund, it's delivered about 8.5%, 9% this year before any assumptions about manager outperformance in either any of those asset classes. So that's a pretty good return. We normally target a base return of about 7%. If you look at that portfolio versus Australian equities that have been a bit disappointing, it's been better than Australian equities and it's been better than cash. So it's been a reasonable year for balanced growth funds. I think obviously in hindsight, you always wish you can do things a little bit differently. Yes, global equities have been the star of the show this year, led by the US. So we upweighted from underweight to neutral in December. We obviously in hindsight wish we had a little bit more going into the new year. So that's probably the area where we could have had a bit more allocation looking back from where we were 12 months ago.
Sure, okay. Have you been buying more global equities over the course of the year then?
Well, the good news is we went a little bit overweight in January. So came back from holidays a little bit more optimistic on the US inflation cycle, the US economy. So we did nudge a bit more overweight. So from that perspective, that was a good thing. But I guess when the US market does 20% in a year, you wish you had more.
Yeah, no, of course. Let's speak to that then. I'm curious if you could tell us about maybe one or two big changes that you actually did make to client allocations this year.
Yeah, well, apart from the incremental push from underweight to neutral December, then the overweight in January to global equities, the other big allocation shift this year was to introduce a conviction overweight to fixed interest just in October, so relatively recently. We saw that big move up in both US and Australian 10-year yields to 5% briefly in October. So just ahead of that, we moved to a pretty significant overweight in fixed interest on the view that it was getting a little bit overdone. And we're pretty happy with that position. Took a couple of weeks to gain a bit of traction, but we're happy to see yields starting to rally over the last few weeks.
Okay, interesting. So buying into fixed interest, I have to ask as a follow-up, are you talking about buying into long duration as well? I know that's a trade that some fixed income people like to talk about.
Yeah, well, we tend to hold a mix of fixed and floating, but fixed is the core. So we like duration at the moment, still with yields well above 4%. So we like duration. We also hold some floating rate credit, not difficult to get in public credit, 7% on floating rate credit in the Aussie market at the moment. So a balance of both, but it's certainly a pretty solid allocation to what you call duration-based strategies.
Yep, okay, I understand. You also appeared on Signal or Noise in April, and what I thought was interesting from that episode, I mean, you discussed some of your reasons for why you were overweight quality stocks, and I think you mentioned some notes on emerging markets as well. I'm curious whether that's still the case, and how do you see both of those themes playing out into 2024?
Yeah, we always tend to be overweight quality, but we got particularly interested in quality and quality growth around the back end of last year after you saw a pretty harsh sell-off in particularly quality growth through 2022 off the back of that rise in interest rates. So from that perspective, we introduced a direct equity portfolio skewed towards those quality growth names, particularly mega cap US tech, luxury brands, some quality healthcare stocks. So that portfolio's done very well over the last 12 months. So we're happy we did that. We stuck with our quality growth managers who've had very good returns this year. Generally, we always hold a quality manager at the core. So pretty happy with the quality trade in its various guises. EM's probably been the big disappointment. We, like a lot of people, thought the China reopening this year would give a bit of a kick to emerging markets. Has been a disappointment. So from that perspective, that's I guess an area where we wish we were a little bit less optimistic. But I think going into 2024, there are signs China's stabilising. Sentiment towards emerging markets is pretty bleak, which I think is conversely a positive signal. And the US dollar looks to be coming off the top. So from that perspective, we're happy to sort of go into next year with an overweight in EM. But yeah, last year was a bit disappointing.
Yeah. Okay. Well, that's interesting then that you've kept your overweight into EM. So I think we've alluded to this a little bit already, but I'd like it in kind of greater detail, if you would. What is one opportunity and one risk you are keeping a close eye on for 2024?
Yeah, I think in terms of the opportunity, I think it is the fact that the macro environment looks pretty constructive for risk assets. Inflation's coming down, growth's slowing but not too dramatically. So from that perspective, we still like equities in a general sense, particularly US equities. We think the macro is not too bad for that trade still, despite them having a good year. On the risk side, I guess it's having, as you said, gone through this year where crisis averted in terms of the US recession. We're still watching pretty closely the global business cycle, both in the US and more broadly. We still think there is a risk that, not a central case, but there is the risk that the US and global economy slows more than people expect. Just when people get comfortable with the soft landing, it's not impossible that things actually do slow down quite substantially. So that's probably the risk we're monitoring most closely. Inflation, particularly globally, I think it's under control, but I think the growth cycle is still an area of uncertainty over the next 12 months.
I was about to ask a question about one asset you're buying more of to harness the opportunity, as you say, and the fact that you've been talking throughout this interview about that overweight into US equities and coming more into US equities. But I might tweak that to ask you this. When you're talking about buying into US equities, are you talking about the Magnificent Seven, or are you looking more in that other 493, if you like, the S&P 500 minus the mega cap tech?
We wouldn't overtly not invest in the Magnificent Seven.
Sure.
I think to state the obvious, I don't think they can do what they did this year again. So I'd be looking for a broader advance in the US stock market than last year, perhaps not as spectacular overall. I don't necessarily think the Magnificent Seven are going to perform poorly, but I would expect maybe a more normal year, if there is such a thing, where the US stock market rises, but on a much broader front than we saw last year.
Okay, so that's one asset you've been buying more of. Similarly, or conversely, I should say, is there one asset that maybe you are selling or avoiding to mitigate your exposure to some of those key risks that you've been talking about?
We're actually overweight fixed interest on the basis that we could be wrong.
Right.
So from that perspective, if the global economy does slow more than expected, fixed interest could do extremely well. Now, equities won't do well, but it's possible if the global economy has a recession or is right on the cusp of recession, long-term interest rates could rally 100, 150 basis points. So when you do the maths on the capital gain there, as well as your running yield you're starting with, you could end up with a double-digit return in fixed interest. Now, it won't completely save a growth portfolio, but certainly I think as a hedge, if we get it right, fixed interest will probably deliver 5, 6, 7%. If we're wrong and things are a lot weaker economically, then fixed interest will give you a double-digit return. So that'll be a pretty valuable hedge at a time where equities are probably struggling.
Okay, well that's interesting to note then. So we've talked about opportunities, we've talked about risks. I am curious, especially as somebody in your position, is there one thing that you think that the market is flat out getting wrong, or it's flat out missing ahead of 2024?
Well, markets move very quickly. If we were having this conversation a month ago, I would have said the market's missing this big slowdown in global inflation, but the market's rapidly starting to factor that in now and factoring in quite a lot of cuts for both the Fed and the ECB.
And doing a lot of catch up in the process.
Yeah, that's right. So we've been on that sort of hobby horse for quite a while, this idea that inflation in the US is actually coming down a lot quicker than people anticipated. Still a little bit of an argument around Australian inflation, but I think US inflation is certainly on the right track, and so is European inflation, for that matter. So still like that notion. Beyond there, but we get back to just the idea that people are constantly death riding the US stock market. It's been a hobby horse of mine for 5-10 years. People are always saying US market's expensive, it's in a bubble. I still think you get what you pay for, and the US stock market is very high quality when you look what's in there. So I still think the consensus, even though it's getting a little bit exuberant near term, I still think a lot of asset allocators are too negative on the US stock market about its longer term prospects. I'm still pretty constructive on a multi-year view.
Okay, well that's very interesting. Last question. As we all lick our wounds or celebrate, depending what kind of 2023 you had, do you have a tip or a lesson for investors heading into next year, given your perspective, given where you are as a CIO, head of investment strategy, I should say?
Well, I think, as is almost always the case, expect more volatility. Things are never a smooth ride, even in what's been a pretty good and relatively benign year. There's certainly been plenty of lumps and bumps along the way. There's often more noise than signal in markets. So I think, obviously watch what's going on in the global economy, global markets, but don't overreact to noise. Stay focused on your long-term investment. Generally, it pays not to panic. So from that perspective, I think that's always worth remembering in terms of some advice for any year, really.
Sounds like a lot like a show that we do here at Livewire, doesn't it? David Cassidy.
I think I've been on that show.
Yeah, something like that. Hey, David Cassidy of Wilsons Advisor, thank you very much for joining us. Really appreciate it.
Terrific. Thanks for having me.
And thank you for joining us. Don't forget that you can catch all of our great interviews at Livewire Markets, Market Index, and our YouTube channel as well. Thanks for watching.